Good afternoon, everyone. This is Edward Talisse for Chelsea Global Advisors and the CQF Institute. It's Tuesday, October the 28th, and I'm sitting here in the CQF Institute's offices in Lower Manhattan. Since we last talked, the market has staged a nice recovery, and all risky assets pretty much have almost all but forgotten the panic and the peril that we experienced in the earlier parts of the month. After today's price action, the S&P index is trading at around 1985, 1986, which is really only about 15 to 20 index points below the all-time high that we saw in August and September. So, where do we go from here? I think the most important thing to remember is that instead of trying to time the market and to move in and out of all these ups and downs in the market, my expectation is that the equity markets, and principally in the United States, are going to return anywhere between 6 to 9% total returns, which is in line with pretty much the historical average. So I see a benign to positive environment for equity markets and other risky asset markets between here and the end of the year. Also, for the bond markets, 10-year U.S. Treasury notes have settled into a range of around 230 to 235. Unbelievably, 10-year notes traded down in yield to around 175 or 178 at the height of the panic earlier in the month. And I believe that the market will probably end somewhere around 2.5% in 10-year notes. The other thing that's really happened, and I think this is the only thing that probably will not correct anytime soon, is that we've had a real collapse in global energy prices. The headline energy sector represented by Brent crude or West Texas Intermediate, all these prices of oil are down anywhere between 15 to 25%. And if you think about it, it's a really, really big move. And most of the sell-side investment banks today had cut all their long-term forecasts. So nobody out there is really expecting any return to oil prices trading 100 to 110 that we saw in early parts of the year. Let's not forget that lower oil prices are also a huge boon to consumers, particularly here in the United States. Gasoline prices are now hovering around $3 a gallon, which is very low compared to where it's been recently. And this will provide consumers with a very strong headwind between now and the end of the year, where holiday sales seasons are really starting to pick up. Lastly, I wanted to also touch on this weekend's results of both the European banking authorities and the ECB's release of the stress tests. Stress tests for many European banks, I think they tested 113 institutes, pretty much came out as expected and showed that, with a few notable exceptions in Greece, Spain, and Portugal, and Ireland, that the European banking sector is in pretty good shape. However, the market in Europe did not necessarily see it that way and immediately traded shares of the European bank stock sector anywhere lower from about 1.5% to 2.5%, so on average about 2% lower. I don't think this really says a lot, other than the fact that the ECB has a large job ahead of itself, along with the European Banking Authority, to convince the markets of its credibility. But I do, from my own standpoint, think it's a very, very good start. It's also interesting to note that the EBA and the ECB had to go into their own websites and take down some of the results of the test due to statistical and mathematical mistakes that were made in some of the aggregation numbers. I don't blame any of the statisticians or analysts at the ECB or the EBA. It's a very difficult task to aggregate such large volumes of data, but it does call into question trading strategies based on highly aggregated data, which is something that, for at least my own account and my clients' accounts, I try to stay away from. So what are we looking at for now and the rest of the quarter and the rest of the month? Earnings season is pretty much behind us, and as expected, most companies reported favorable earnings. And we all understand that it's a bit of an earnings game where expectations are lowered ahead of releases in order to allow companies to beat the earnings. Nonetheless, except for a few big exceptions such as Coca-Cola, IBM, and Amazon, most U.S. companies showed very strong top line growth in revenues and EPS growth while maintaining solid dividend growth track as well. So all indicators really between now and the end of the year for risky assets pretty much look positive. We have trend to above trend growth here in the U.S., which is going to come in for third quarter probably around 3%. Unemployment is dropping. Prices are extremely stable and again are providing a headwind to the consumer as energy prices move lower, and liquidity conditions are also remain very favorable. At the end of the year, again, I expect that full year total returns for the headline indices for the S&P and maybe even the Dow return somewhere between 6 to 8%. So lastly, I wanted to go back to something that we touched on in one of our earlier videos is what I call my market risk indicators. I use this table here to sort of assess where we are and how I should feel and look and think about the investment climate for the next 6 months to 1 year. So I have a whole host of market risk indicators going down here in the table. I assign various weights to them. The assignment of weights is not very sophisticated. It's based on my own understanding and my own expectation of how the rest of the market views these indicators. But I weight them between high, medium, and low. And then I assign scores based on if I believe the particular indicator is either supportive or not supportive or neutral for risky assets. The overall index, after you calculate the weight times its ratings, should return somewhere between 0 and 50. 50 meaning that the investment horizon is pretty neutral for risky assets. Above 50 is that it's supportive for risky assets, and below 50 it's not a good time to invest in stocks or other risky assets. So right now I think that the overall environment is quite positive. I have a rating of around 59, which is my high for the year. Notably, I upgraded two things since I last did this. I upgraded market breadth. It used to be red, now it's yellow, more neutral, and I also upgraded the European economy, which used to be red, which is now neutral. I think on the market breadth side, the flush out that we had for the early part of October is probably healthy, as a lot of shares changed hands between people that were a little nervous about holding them and to people that could hold them for longer term. Lastly, here on the European economy, I do think that longer term what the ECB has done and the fact that they're going to take over European-wide bank supervision is a very strong positive for the European economy. And over time, people in Europe and the rest of the world should be able to put some of the banking problems and sovereign risk problems in Europe behind us and focus on really what's going on in the real economy in Europe. And I think that overall is positive. Thank you very much, and please remember you could always find this video on CQF's Institute website and on Chelsea Global Advisors website.